So a limited company is a separate legal entity. It's usually limited by shares, but it can also be limited by guarantee. And that essentially means that the shareholder subscribing for the shares will essentially have their liability limited to the number of shares that they take and the amount that they pay for those shares. There'll be no other liability in terms of the shareholder, which essentially means that the shareholders can reduce their risk in a company in that their only liability is in relation to the shares that they acquire. So if anything happens within the company, they won't have any personal liability issues.
So the lovely thing about a limited company is that the tax position with regards to any profits made will be taxed under corporation tax. Now corporation tax is 19%. If there's any capital gains made in the company, they're also taxed under corporation tax at just 19% too.
In terms of personal tax, usually the personal tax at basic rate is 20%, so that compares with a limited company of 19%, and as you can see that compares favourably. You can take dividends out from a company. They will be taxed at 7.5% under basic rate and 32.5% as higher rate taxpayer. The good thing about a company is that you can retain profits within that company, so that if you don't want to take any dividends or any income from that company in the year, you don't need to, in which case you'll only pay the tax at 19% and no additional tax.
One of the most common issues that we see when clients join us with a limited company is that they may have structured their shares in such a way that they're not taking maximum tax efficient benefit from all the profits that they could be taking out of that business. The second issue we sometimes see is that clients have loaded assets inside the limited company without considering the tax implications of that movement to putting those assets inside the limited company.
Something that we found with regards to clients upon talking to us is that they've not really maximised their efficiency in terms of the share structure of the company, and we can help with that.
So our clients have benefited from our support by us helping them restructure their business so that they can ensure that shareholders are structured to get the very most out of the company tax efficiently every year based upon their needs. And that could be a combination of salary and dividends, and we'll help the client work through what the most tax efficient structure of those two should be each year.
It is important for clients to get their share structure right. We would advise usually to have different alphabet shares, A, B, C, etc., so that each shareholder can take a different level of dividend from the other shareholders without having to take the same amount depending on their share structure and holdings.
Another superb advantage with a limited company is that a limited company can pay for the pensions of its directors' shareholders. So if you aren't already contributing to a pension or cannot contribute a significant amount of money because of the earnings you have personally, then your limited company can take over that responsibility for you and start contributing, if the opportunity arises, to the maximum allowance each year without you having to put your hand in your pocket.
Just following on from Louisa's comments, as an individual without an income, you could invest £3,600 per annum into a pension. Within a company, with the company making that pension contributions for you as an employer's contribution, the company can pay £40,000 to you as an individual into your pension scheme.